Hello students, welcome to the lecture on obstacles for capital budgeting, and after the lecture we will be able to learn the following objectives. Explain the principles of capital budgeting, discuss the steps of capital budgeting, explain the meaning of ranking of capital budgeting, discuss classification of investment proposals, describe the capital budgeting appraisal methods, explain the types of investment risk. Let us start with an introduction to capital budgeting. Capital budgeting is the process of identifying and selecting investments in long-lived assets, where long-lived means assets expected to produce benefits over more than 1 year. In this reading, we first look at the capital budgeting process in general. After looking at the broad picture of how investment decisions are made, we look at how projects may be classified. This classification helps us identify of the cash flows we need to consider in our decisions. We then look at the mechanics of estimating future cash flows using estimates of future revenues, expenses, and depreciation. We summarize the analysis of cash flows with examples analyzing two different investment projects. Capital budgeting, broadly defined as a decision-making process that enables managers to evaluate and recognize projects that are valuable to the company, which is usually the dominant mission facing any financial manager and his or her team. It is the most important task for managers for the following reasons. First, the strategic decisions and directions of a company, new products, new services, and expansion into new markets are determined by the company's capital budgeting. Second, capital budgeting decisions usually result in relatively long-lasting effects to the company and therefore a decrease in flexibility. Third, serious consequences may arise from poor capital budgeting decisions. For example, if a company devoted too much capital to one project, the company's capital would be unnecessarily spent on excess production capacity. On the other hand, if less than required capital was invested by the company, its productivity would suffer by the simple fact that its equipment, computer hardware, and software might not be cutting edge to improve production. These poor capital budgeting decisions may allow rival companies the opportunity to steal market share by taking advantage of a lower cost structure or production capabilities matching demand.
Today's dollar value, and the expected cash flows from the projects are in future dollar value. To make a decision on whether to accept or reject a project today, both cost and future cash flows must be in today's dollar value. The factors involved in capital budgeting decisions are future sales, expected cash flows, capital expenditure, timing. The purpose of any investment is to generate profit. To generate profit, first the firm needs to generate sales, manage costs, produce positive cash flows that are large enough to recover the investment, and generate profit. In addition, business does not have access to unlimited capital, and the availability of capital will influence the investment decision. The timing of each cash flow affects the present value of cash flow, and the timing of investment will affect the future revenues. Capital budgeting projects are generally classified as replacement, expansion, safety, security and environment, and other. Companies have to replace old equipment because of breakdowns, lower productivity, or technological obsolescence to maintain the production capability of the firm. Replacement projects are the most common capital budgeting project in the business. Expansion project occurs as a result of company's strategy to produce new product or to enter new market or new industries. A change in environment and government regulation leads to safety, security, and environmental projects. Other projects are research and development project based on the strategic planning of the firm. The goal of the capital budgeting analysis is to determine the profitability of the project. Profitability of the project is determined by analyzing three cash flows of the project. 1. Cash outflows, the money invested in the project. 2. Cash inflows, money generated from the investment. 3. Terminal year cash flows, money received from the sale of the used assets at the end of the project. Let's draw a timeline for capital budgeting project. Assuming the life of the project is 5 years. Cash outflows are posted on the left-hand side at period 0. The cash flows are negative because money is going out of the company. Cash flows generated from the project are referred to as cash inflows and occurs after the investment. They are positive because money is coming into the firm. Assuming that the equipment can be salvaged, the salvage value and any other end-of-the-year cash flows from the project are posted on the year 5. The goal of the capital budgeting analysis is to determine profitability of the project. The investment in the project is made on period 0 and the cash flows will be received at a future date. In capital budgeting analysis, all the future cash flows, which is CF1, CF2, CF3, CF4, CF5, and terminal year cash flows for year 5 are brought to today's value by computing the present value of the cash flow. The difference between the present value of the cash flows and the initial investment is referred to as net present value. If the present value of future cash flows from the project is greater than initial investment, the net present value is positive and project is profitable. The following are commonly used decision criteria to evaluate capital budgeting project. Number 1, payback period. Number 2, net present value. Number 3, internal rate of return. Number 4, modified internal rate of return. Number 5, profitability index. Payback period. Payback period is the amount of the time required to recover initial investment in a project. It ignores the time value of money. Net present value. Net present value is the difference between present value of cash inflows and present value of cash outflows. Internal rate of return. Internal rate of return is the rate of return at which the net present value of the project is equal to 0. In the IRR calculation, it is assumed that cash flows from the project are reinvested at the internal rate of return. Modified internal rate of return. Modified internal rate of return is based on the assumption that cash flows from the projects are reinvested at the cost of capital, which is weighted average cost of capital. Initial investment is equated to the sum of the future cash flows that were reinvested at the cost of capital to compute the interest rate. Profitability index. Profitability index is the ratio between present value of cash inflows and present value of cash outflows. Project acceptance or rejection criteria. If net present value is greater than or equal to 0, project is acceptable. If the net present value is less than 0, reject the project. Internal rate of return is greater than or equal to cost of capital, project is acceptable. If the IRR is less than cost of capital, reject the project. Modified internal rate of return greater than or equal to cost of capital, accept the project. If MIRR is greater than or equal to cost of capital, project is acceptable. If MIRR is less than cost of capital, reject the project. If profitability index is greater than the 1, accept the project. Profitability index is less than 1.
Let us now discuss the principles of capital budgeting. Capital budgeting is the process of evaluating and implementing a firm's investment opportunities by virtue of properly identifying such investments that are likely to enhance a firm's competitive advantage and increase the shareholder wealth. A typical capital budgeting decision involves a large upfront investment followed by a series of smaller cash inflows. A typical capital budgeting process is focused around 5 basic principles: potential cash flows and not accounting income. If a project is undertaken and subsequently some relevant incremental cash flows are to flow out by virtue of such a capital budgeting plan, the relevant cash flows are to be considered as a part of the budgeting process, and the decisions on capital budgeting have to take such incremental cash flows into consideration before properly evaluating such a capital budgeting plan. However, the sunk costs, which can't be avoided even by overlooking or avoiding such a capital budgeting plan, should not be considered for acceptance or rejection of the project. However, while finalizing a capital budgeting decision, one needs to examine the impact of implementing such a plan on the cash flows of related activities undertaken by the same group, which has some synergy with the proposal for which the capital budgeting is being undertaken. If the sales of some related company within the same group are likely to face shrinkage following the implementation of such a plan, the capital budgeting plan should take such a potential cash inflow loss into account before going for the proposed plan. In other words, if potential cash flows are likely to have a detrimental effect on the cash flows emerging out of existing business, both of them need to be examined carefully before finalizing the capital budgeting plan. Such a typical case where an existing cash flow may suffer due to potential cash flow of the new and improved facility is called cannibalization or externality. Cash flows are based on opportunity cost. Any firm that undertakes an analysis of taking up a project may end up finding up that there may be alternative plans available to boost its potential cash flows out of the funds it is applying in the capital budgeting. Such cash flows which need to be foregone for undertaking the capital budgeting plan are typically considered as the opportunity cost for the firm and a key parameter before making a choice on whether to implement the project or forego it. Such opportunity cost should be duly considered while making a final choice on whether or not to implement the new project. The timing of cash flow. It should be kept in mind that the timing of cash flows subsequent to the capital budgeting, when the cash outflows move out of the system, are important for undertaking a project. Typically, the earlier the cash inflow starts to plow back into the business, the higher is its value. Post-tax analysis. It is important to know that all cash flows accruing into the business should be considered only after taking into account the tax implication of such cash inflows or only on a post-tax basis. Financing costs reflected in projects' required rate of return. Once the opportunity costs are considered to evaluate the project, it is widely accepted that the project no longer requires considering the financing costs, which get built into the system automatically once the entire project is examined with a perspective from the required rate of return.
This is the first video in our Capital Investment Decisions and the Time Value of Money series. And I'd like to go ahead and remind you that we have the lecture notes that we use in these videos on the website at theaccountingdoctor.com. And we encourage you to go download those, print those out while you're watching these videos, and take notes directly from the video. In this first video, we are going to be talking about capital budgeting and briefly introducing the 4 capital budgeting models. So when we talk about capital budgeting, we're specifically talking about how we budget for the acquisition of our capital assets, so those depreciable assets. There are 4 models that we can use when discussing capital budgeting decisions, and we'll have videos that will discuss each one of these in more detail. But the first one is the payback period, the second one is the accounting rate of return, the third one is called the net present value model, and the fourth is the internal rate of return. The first two, the payback period and the accounting rate of return, are used for short-term business decisions. This is because these two models ignore the time value of money concept, which we'll get into later on as well. The other 2 capital budgeting models, net present value and internal rate of return, they focus on long-term business decisions because they incorporate the time value of money concept. Anytime we're considering a capital budgeting decision or investing in a capital asset, we have to focus on the cash flows of that investment. So we have to think about what cash is that investment going to bring in, or the cash inflows, and what will be the cash outflows because of that investment decision. So let's first talk about the cash inflows that we can see from a capital investment. For example, the future cash revenues that will be generated from that investment. The future savings in ongoing cash operating costs resulting from the investment. So think about a piece of equipment, a new piece of equipment versus an old piece of equipment. So a new piece of equipment will likely require less operating cost than would an old piece of equipment. Also, you have to think about future residual value. So if you plan on a piece of equipment lasting for 10 years, and at the end of that 10 years you could sell it for $5,000 or $10,000, that residual value is the same thing as a cash inflow at that time. And the cash outflows due to a capital investment would be that investment's ongoing cash operating costs, refurbishment, repairs, and maintenance costs that are involved with any capital investment, be it equipment, building, whatever. You also have to consider one of the most obvious cash outflows, the cost of that new investment.
Let us study the process of capital budgeting. A company undertakes capital budgeting in order to make the best decisions about utilizing its limited capital. Identification of investment proposals. The capital budgeting process begins with the identification of investment proposals. Investment opportunities have to be identified or created. They do not occur automatically. Investment proposals of various types may originate at different levels within the firm. Most proposals in the nature of cost reduction or replacement or processor product improvement takes place at plant level. The contribution of top management in generating investment ideas is generally confined to expansion or diversification projects. The proposal may originate systematically in a firm in view of the fact that enough investment proposals should be generated to employ the firm's funds fully, well and efficiently. A systematic procedure for generating proposal may be evolved by a firm. Screening the proposals. The expenditure planning committee screens the various proposals received from different departments. The committee views these proposals from various angles to ensure that they are in accordance with the corporate strategies, selection criterion of the firm, and also do not lead to departmental imbalances. Evaluation of various proposals. The evaluation of projects should be performed by a group of experts who have no axe to grind. For example, the production people may generally be interested in having the most modern type of equipment and increased production even if productivity is expected to be low and goods cannot be sold. This attitude can bias their estimates of cash flows of the proposed projects. Similarly, marketing executives may be too optimistic about the sales prospects of goods manufactured and overestimate the benefits of a proposed new product. It is therefore necessary to ensure that projects are scrutinized by an impartial group and that objectivity is maintained in the evaluation process. A company in practice should take all care in selecting a method or methods of investment evaluation. The criterion or the criteria selected should be a true measure of evaluating if the investment is profitable in terms of cash flows, and it should lead to the net increase in the company's wealth, that is, its benefits should exceed its cost adjusted for time, value and risk. Fixing priorities. After evaluating various proposals, the unprofitable or uneconomic proposals may be rejected straight away. But it may not be possible for the firm to invest immediately in all the acceptable proposals due to the limitation of funds. Hence, it is very essential to rank the various proposals and to establish priorities after considering urgency, risk and profitability involved therein. The final approval and the preparation of capital expenditure budget. Proposals meeting the evaluation and the criteria are finally approved to be included in the capital expenditure budget. However, proposals involving smaller investment may be decided at the lower for expenditure action. The capital expenditure budget lays down the amount of estimated expenditure to be incurred on the fixed assets during the budget period. Ranking of capital budgeting. When a number of projects appear to be acceptable on the basis of their profitability, the projects will be ranked in order of their profitability in order to determine the most profitable project. Ranking of capital investment proposals is particularly necessary in the following two circumstances: where capital is right, that is, there is a limit on funds available for investment; where two or more investment opportunities are mutually exclusive, that is, only one of the opportunities can be undertaken. Thus, the objective of ranking is to put the capital available to the best possible use. NVP and IRR in terms of conflicting rankings and the theoretical and practical strengths of each approach. Conflicting rankings of projects frequently emerge from NVP and IRR as a result of differences in the reinvestment rate assumption as well as the magnitude and the timing of cash flows. NVP assumes reinvestment of intermediate cash inflows at the more conservative cost of capital. IRR assumes reinvestment at the project's IRR. On a purely theoretical basis, NVP is preferred over IRR because NVP assumes the more conservative reinvestment rate and does not exhibit the mathematical problem of multiple IRRs that often occur when IRRs are calculated for non-conventional cash flows. In practice, the IRR is more commonly used because it is consistent with the general preference of business professionals for rates of return, and corporate financial analysts can identify and resolve problems with the IRR. The proposals and classification of investment proposals. A proposal is a plan for solving a problem. Engineers and scientists write proposals to do such things as research turbulent boundary layers, design turbine blades, and construct jet aircraft engines. The audience for a proposal usually includes both managers and engineers. These audiences view proposals in different ways. For instance, managers review proposals to see if the plan for solving the problem is cost effective. Engineers and scientists, on the other hand, review proposals to see if the plan is technically feasible. A proposal is an essential marketing document that helps cultivate an initial professional relationship between an organization and a donor over a project to be implemented. The proposal outlines the plan of the implementing organization about the project, giving extensive information about the intention for implementing it, the ways to manage it, and the results to be delivered from it. A proposal is a very important document. In some cases, a concept note precedes a proposal briefing the basic facts of the project idea. However, the project idea faces a considerable challenge when it has to be presented in a framework. The proposal has a framework that establishes ideas formally for a clear understanding of the project for the donor. Besides, unless the ideas are not documented in writing, they do not exist. Hence, a proposal facilitates appropriate words for the conception of an idea. Proposals have recently become more sophisticated. This reflects the increased competitiveness and the larger resources existing in the NGO sector. The trend of inviting proposals for contracting development program began with the allotment of substantial resources for development that triggered off the mushrooming of NGOs around the world. Enormous opportunities existing in this sector have led to the trend of making proposal writing a profession. Proposal writing poses many challenges, especially for small and unskilled NGOs. Here we discuss some basic and necessary information required for developing a proposal. There are three distinct categories of business proposals: formally solicited, informally solicited, and unsolicited. Solicited proposals. Solicited proposals are written in response to published requirements contained in a request for proposal RFP, request for quotation RFQ, and request for information RFI, or an invitation for bid IFB. In a solicited proposal, a company or agency advertises that it desires the solution to a problem. In most cases, this company or agency sends out a request for proposals, often called an RFP, that presents a problem which needs addressing. For example, if the Department of Energy desires research on reducing nitrogen oxide emissions from diesel engines, then the department announces its request, often in periodicals such as the Commerce Business Daily. A company then reads the announcement and proposes a plan for doing the research. The net present value, or the NPV, was first applied to corporate finance by Joel Dean in 1951. Replacement. The main objective of modernization and replacement is to improve operating efficiency and reduce cost. Cost savings will reflect in the increased profits, but the firm's revenue may remain unchanged. Assets become outdated and obsolete with technological changes. The firm must decide to replace these assets with new assets that operate more economically. If cement company changes from semi-automatic drying equipment to fully automatic drying equipment, it is an example of modernization and replacement. Replacement decisions help to introduce more efficient and economical assets and therefore are also called reduction investments. However, replacement decisions which involve substantial modernization and technological improvements expand revenues as well as reduced costs. Expansion. Sometimes the firm may be interested in increasing the installed production capacity so as to increase the market share. In such a case, the finance manager is required to evaluate the expansion program in terms of marginal cost and marginal benefits. Diversification. Sometimes the firm may be interested to diversify into new product lines, markets, production of spare parts, etc. In such case, the finance manager is required to evaluate not only the marginal costs and benefits but also the effect of diversification on the existing market share and profitability. Both the expansion and diversification decisions may also be known as revenue increasing decisions. The types of investment risk. Every investment opportunity carries some risks. In some investment, a certain type of risk may be predominant and others not so significant. A full understanding of the various important risks is essential for taking calculated risk and making sensible investment decisions. 9 major risks are present in varying degrees in different types of investments. The risk of the loss of principal. This is the most basic kind of risk. The principal is the original amount of money that we invested. If we buy a stock or a mutual fund or invest in real estate, there is no guarantee that we will get all of our principal back. We can greatly reduce or eliminate the risk to our principal by keeping our money in a bank savings account, purchasing a fixed term deposit, agreeing to deposit our money for a specified amount of time, or buying investment grade bonds. But even when we guarantee our principal, there are still other kinds of risk. Default risk. This is the most frightening of all investment risk. The risk of non-payment refers to both the principal and the interest. For all unsecured loans, example loans based on promissory notes, company deposits, etc., this risk is very high. Since there is no security attached, we can do nothing except, of course, go to a court when there is a default in refund of capital or payment of accrued interest. Business risk. The market value of our investment in equity shares depends upon the performance of the company we invest in. If a company's business suffers and the company does not perform well, the market value of our share can go down sharply. This invariably happens in the case of shares of companies which hit the IPO market with issues at high premiums when the economy is in a good condition and the stock markets are bullish. Then if these companies could not deliver upon their promises, their share prices fall drastically. When we invest money in commercial, industrial and business enterprises, there is always the possibility of failure of that business and we may then get nothing or very little on a pro rata basis in case of the firm's bankruptcy. Liquidity risk. Money has only a limited value if it is not readily available to us as and when we need it. In financial jargon, the ready availability of money is called liquidity. An investment should not only be safe and profitable but also reasonably liquid. An asset or investment is said to be liquid if it can be converted into cash quickly and with little loss in value. Liquidity risk refers to the possibility of the investor not being able to realize its value when required. This may happen either because the security cannot be sold in the market or prematurely terminated, or because the resultant loss in value may be unrealistically high. Now, in the end, let us summarize what we have learned in this lecture. Capital budgeting is the process most companies use to authorize capital spending on long-term projects and on other projects requiring significant investments of capital. Any firm that undertakes an analysis of taking up a project may end up finding out that there may be alternate plans available to boost its potential cash flows out of the funds it is applying in the capital budgeting. A company undertakes capital budgeting in order to make the best decisions about utilizing its limited capital. Proposals meeting the evaluation and criteria are finally approved to be included in the capital expenditure budget. A capital projects reporting system is required to review and monitor the performance of the investment projects after the completion and during their life. The payback is one of the most popular and widely recognized traditional methods of evaluating investment proposals.